Hello and welcome to Inside ETFs. I'm Ramzan Karamali. Today we're looking at flows into ETFs this year, and my guest is Ryan Jackson, Senior Manager Research Analyst at Morningstar. Inflows into exchange-traded funds are on course to surge to new record highs this year. According to BlackRock, investors poured in just shy of $130 billion into them in August. That's despite the volatility at the start of the month, when the S&P 500 fell 6% in just 3 days. August's strong performance followed a record high $198 billion of inflows in July. And in fact, for the first 8 months of the year, total inflows are over $120 billion ahead of the last record year of 2021. So what's behind this strong interest, and can it continue? Well, to help answer that and more, I'm joined by Morningstar's Ryan Jackson. Ryan, thanks so much for joining us. So let's start with that. Why are we seeing such amazing flows into ETFs this year, and can we hit $1 trillion even?
Yeah, thanks for having me on, Ramzan, and you nailed it. We're surging towards record highs here in 2024. Through August, global ETFs on pace for about $1.2 trillion per year. So that $1 trillion mark is absolutely well within reach. And yeah, it's been a great year for a bunch of reasons, and it's a good time to invest, and ETFs have clearly emerged as the vehicle of choice to do that. You think about the backdrop for investment right now, and it's been very favorable for a variety of reasons. You look at a lot of those economic concerns that were sort of plaguing the market in 2022 and kind of spilled into 23. Knock on wood, don't want to speak too early, but a lot of those have largely been put to rest. Gives investors a little bit more confidence to spend their money and invest it for the long term. You look at the global stock market, up about 15% through August, and up without much volatility along the way. So you've seen quite a bit of gain and not a whole lot of pain to actually get there. Sure, some stumbles in August a little bit, but overall, pretty smooth sailing for a lot of equity investors. And then even in the bond world, had a rocky start to the year, but have really found their footing. There's the expectation that the Fed is soon to begin their easing cycle. And all the while offering some of the highest yields that we've seen since the global financial crisis. So, pick your asset class. It's been a pretty good time to invest your money. And all the while, we've seen ETFs take over a lot of that market share from mutual funds. It's certainly not a zero-sum game, all things considered. We've still seen quite a bit of inflows so far this year. But you look back in previous years, and it's mutual funds and outflows, exchange-traded funds taking in quite a bit of new money. That trend has continued into 2024, and it's certainly tipping the scales in favor of ETFs.
How surprised have you been by the launch of so many new funds as well? Why do you think that is?
So the ETF market, going back to its inception in the late 90s, it's always about innovation and kind of finding new frontiers. When you look at the rise of active ETFs, I think that's really sparked, a new gold rush into the ETF wrapper, where, all of a sudden, a lot of fund providers who do have the resources to launch quality funds had been sitting on the sidelines, suddenly see their way to enter into the market. And then you look into some of those kind of trendier, more niche areas of the ETF market, talking covered call ETFs, buffer ETFs, even some of those sort of leveraged single stock products. We'll see what kind of longevity those products have to offer.
And 2024 has also seen the rise of Bitcoin ETFs too. I mean, if you strip those out, would we still be talking about record inflows this year?
I'm glad you said that, because that's another key one that I left off that initial list. So that kind of the big ETF story early on this year was the approval of spot Bitcoin ETFs in January of 2024, and with that saw the launch of, call them the new 9 spot Bitcoin ETFs in January. They were met with huge demand. This is something that investors have been clamoring for quite some time. So from their launch through the end of August, just in the US, we saw those new 9 pull in about $37 billion of inflows, a massive number. These were record debuts for a lot of these ETFs. Clearly something that investors were very excited about. Now, to kind of bring it back down to earth a little bit, I said $37 billion. A lot of that came because it cannibalized some of the existing futures Bitcoin ETFs. Grayscale Bitcoin Trust, GBDC, was the main casualty. Is it personally shed about $17 billion in assets. So when you kind of net things out, it ends up being about $19 billion this year into those new Bitcoin ETFs. Certainly a strong debut, but in the grand scheme of things, that only accounted for about 3% of US ETF flows, an even smaller share of the global market. So While they've certainly given a nice boost kind of at the edges, I don't think you can give them all the credit for propelling such a strong year for ETFs worldwide.
And Ryan, looking forward, what trends should you think investors should be aware of when investing into ETFs?
Yeah, so I hit on it a little bit early on. These active ETFs, I think you'll certainly see more and more of those. It took a while after the passage of the ETF rule in 2019 for a lot of fund providers to kind of get their ducks in a row and make sure they had all the resources, both human and technological, to actually bring ETFs to market. I don't see many signs of that slowing down, so more active ETFs should continue to line the shelves. But I would caution investors to beware of a little bit more of these sort of high-risk, high-reward ETFs that we've started to pop up. Single stock leveraged ETFs have been a very popular one. What these will do is offer leveraged or sometimes leveraged inverse exposure to single stocks. Oftentimes, they're some more volatile equities, companies like Tesla, Nvidia. These, while might be very exciting, they're not intended to be held as long-term instruments. They're designed for day traders, and while they seem very enticing, there's a lot of risk that comes with these products. And for better or for worse, all the money that they've pulled in, I can see how that would encourage potentially new launches like that. So I'll give the word of caution, though I do expect to see some more of those hit the market.
Ryan Jackson from Morningstar, many thanks for your thoughts. And that was your look at inflows into ETFs. I'm Ramzan Karmali, and this is Reuters.